Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, September 14th, 2022. It's 11:58 Eastern Time as I'm starting the video, so we're about halfway through the trading day. And here's what I'm going to do. I'm going to do an update on the equity markets, but cover something a little bit different. I'm going to focus on yesterday's price action. If you followed me for a while, you've heard me say this often. I like to say that one day does not make a trend, but and certain things happen, there may be significance. I'll expand on that in just a second. The charts I got out to you today earlier. It's the same uptrend line. I've not modified this one. Remember that was and still is, well, was my pullback target from up here. After going long there, scaling out of those longs and going and scaling into shorts, and that was my preferred target down there. Is these uptrend lines. We overshot the one on QQQ slightly, but we had a perfect tag of the S&P 500, and then we hit it again. Remember, I say this often. Whether or not I'm trading NQ, RTY, mid caps, small caps, anything else, there is a huge subset of traders. S&P 500 and ES futures are one of the most actively traded, if not the most actively traded index out there. And so, therefore, you need to watch that one, whether you're trading it or not. So, basically, we have another tag of that level. We dropped down, the markets had their worst days since June of 2020. That's what the headlines say. The Nasdaq fell, I think it was 5.2% drop in the Nasdaq composite. S&P not as much, but remember, it never does, rarely does. It's chock full of steady Eddie dividend-paying stocks and things like that. But all right, so that's a level to watch. And as I said this morning, just below it, you see I have the number at 390.33, give or take, round down to 390. You have those recent lows. So it's what I call the BOD, or benefit of the doubt level. The trend line may break, and but obviously you need to see those recent lows get taken out, or you could have a successful test. And I always talk about this, if it's impulsive and it's an intra-period candle, meaning it happens during a 60-minute candle, yeah, it's probably going to stick, but there's quite a bit of times where you break intra-period only to close back up. So if you get a solid 60-minute close, that increases the odds. And if you have a daily close or multiple 60-minute candles, that's all the better. Like I told you before, I think there's a good chance if we can, take out those lows. And I still favor that. I'm doing the video now where we're up about 1% in the Nasdaq, close to it, 3/4. And point is, get ready if it happens, because I think that will be a lot of selling come in there. A lot of stops should get hit, and forced margin call selling and all that good stuff that comes in a bear market. But that's what we're going to talk about in this video. Before I get into that, let me just do a little housekeeping here. Just sort of a reminder, I mentioned from time to time, if you're actively trading or want to know what's going on, or want follow-up to any comments that I made, or you have a question, you've come back into the site and visit the comments section below the post. I don't always do the best job of keeping up on everything there, but I try to when I get a break in my trading. I try to come in, answer questions, or post additional charts and commentaries. So, for example, somebody asked about nat gas, and that's a great question. I told you I've been short nat gas. And my response is in there along with a chart. You can just click that. You'll see the chart there, and you can read my reply. So for now, I'm giving it room, but not much more, because we took out a trend line. And again, the chart's there. You can see what happened. We took out a little trend line, hit resistance, quite a bit of resistance there. If we can power through, or nat gas powers through there, I have a hard time spinning that as anything but bullish, and that's where I'll start to scale out. But as of now, I think we may have overshot that little downtrend line right there, and still get another leg down. And you can see all the levels on this chart too. You have an uptrend line here. Basically, it's a symmetrical triangle pattern. We barely overshot it. And I'm banking on a failure, that's a brief momentum overshoot, and we'll go down there. But I'll respect it if it goes the other way. So again, just a reminder, you'll get updates there. And then also, for example, I followed up on that post I got out to you today with the 60-minute charts. I gave you some 10-minute charts. So if you're whether you're an active trader, what does that mean? Well, you can day trade off these levels. You resistance if both indexes, that's why I gave you both the ES and NQ, you want to see them both take out levels, because if one's at resistance and the other one has just broken out, well, guess what? This one may get rejected and then the indexes go down. You can see there was some divergence here on the 10-minute chart, but again, I'm going to get to kind of the bigger picture, but once again, to make clear, and somebody said something here, yesterday's video concluded with you being short, but today's chart indicates that we should be long. No, I didn't say that at all. I'm sorry if that was misconstrued, so I'll address that right now. Basically, as I pointed out this morning, we're at support. I'm still short. We're at support, and like I said, support is support until unless broken. So this morning we were right there, and this is just basically, this is trading and investing 101. When a stock or an index falls to support, you do one of two things. You either buy that level if you're bullish and you expect a bounce, or if you're bearish, you wait for a break of support. It is 100% contrary to trading or investing to short at support. So that's what I made clear, that if you didn't already have shorts, or if you had shorts and you're planning to add, it doesn't make sense to add right at support, because the buyers can step in and we can rally. So I said, if you're bullish, or you're just agnostic, market agnostic, you don't have any opinion, but you're just trading mechanically, well, then, trading 101 says you go long at support with a stop somewhat below. So that's a pretty simple strategy. Not the strategy I'm doing, just to make clear. I'm sticking with my swing shorts for now, thinking that that level will go, as I think I made pretty clear in the charts I posted this morning. I gave you, when I give you those multiple scenarios, I hate, services that sit there and tell you, well, the market can go up or it's going to go down. Yeah, thanks. I mean, that's pretty obvious. So I listed that this was my preferred scenario, and obviously if support holds and they can rally it off that level, we're going to rally. So my alternative scenario is not the one I'm positioned for. And when in doubt, if I came in with nothing today, I'd have no positions now. I'd wait for a break, because I don't think we're going to bounce very far. So I'd wait for that break of support, and especially those lows right there. Alrighty. The other thing I wanted to show you on the site, regarding the comment section, somebody asked a question the other day. I'm going to use this little search function. They asked about text alerts, and over the years I've gotten this question put to me quite a bit. So I'm typing in the word text, a little drop-up box. I posted it in the post comments. I scroll down here. It's searching by front page posts and then comment section. So here's that comment that I made. So somebody asked, hey, when we offer text alerts. So I just encourage you to go and read the reply. I consider and read it to you now. We're just going to add to the time in the video, but it's very simple. Basically, for the reasons I state here, I don't have them on the site. It's just there's not a simple method to set that up, but you can easily set that up. If you're a subscriber, you're going to get email alerts unless you opted out of those every time a new post is made, and it's very easy. Just about every cell phone carrier has a way to send text by email. So basically, and again, you can use Google. Google's your best friend on this. Just learn how to, or every email client, such as Gmail or Microsoft Outlook, they have ways to filter and set rules for email. So you just basically tell it to forward every email that comes through from right side of the chart to forward to your phone. And this is how you do it. Then you just click this link, and it's going to show you all the carriers, their numbers. Basically, it's your phone number followed by the @ sign, and then whatever they tell you to do. And if you don't see it on here, for example, like Comcast Wireless that runs on the Verizon network, Google it, and there's a way to do it there as well. I'm sorry, yeah, Xfinity Wireless. They're all, again, Google search will tell you how to do that. So pretty easy stuff. And that way, boom, email hits. You're going to get, it should bounce it right away. Your email should then forward it to that number, and then basically you're going to get it on your phone. Okie dokie, back to the charts. All right, so that's what I got you this morning. There it is. We are right at just above support. QQQ, I gave you what I told you is now a new trend line. Before I had a trend line here off the lows. That one was undercut. But as of yesterday, since we hit that level and had a reaction, this is a reaction. I define a reaction as a consolidation, which for the most part, that's all this has been so far since yesterday and today as well. And so that gives it one, what in my book, you need 3 minimum reactions, distinct reactions on the trend line to validate it, because any 2 points can be connected at random. That's the way I look at things. So anyway, it's a trend line there, and more importantly, the S&P trend line has a lot of reactions, so that's valid. And same thing, you have the recent lows just a hair below it. So that's my preferred scenario. But again, if the difference in price is negligible. You're talking less than probably 1%. So I'm just saying, if you want to play it safe, you wait for that level to get taken out. Otherwise, like I like to say, support is support until unless broken. So the buyers could still step in and rally it up. You can see plenty of resistance levels that then will come into play most likely, and so forth and so on. Okay, so here's what I wanted to cover in this, then we'll wrap this video up. I'm going to go to a different board here. This is QQQ. Just ignore this. This is a long-term trend line. I'll just leave it there for now. Okay, so as I said, yesterday we had a drop in the Nasdaq Composite of 5.2%. This is the Nasdaq 100, similar, it's just the top 100 companies in the Nasdaq instead of all of them. But what I've done here, I'm going to zoom in real tight, is I've measured from high to low. That's a green candle, so that means on the fat part that we close at the top of that. There's your close. So I take the line there, and then I run it down to the bottom of this candle, and that angled slope tells me that's 1 day of price history. And so here's where I'm going with this. Again, I say it often, 1 day does not make a trend, but when technical analysis is all about identifying, patterns and developments that have occurred in the past, and then trying to project what may happen in the future based on what happened in the past, when we had similar situations. So what I'm going with that is, it is extremely unusual, and I can't recall it, to see a drop of over 5% in the Nasdaq that did not occur during a downtrend, with more to come, with more to follow. Unless the only exception to that rule, or so to speak, not a rule, but from my experience, is on a bottoming, final capitulation day where you have a big drop, and then there's evidence of a bottom. First of all, there's no evidence of a bottom that I see at all. In fact, we're walking our way down here. This is not near. We had lows right here recently. They haven't been undercut, so I'm going to eliminate that. So my point that I'm trying to make here, and I'm going to show you, is that remember, I only speak in probabilities. I do not speak in possibilities, because anything is possible. Is it possible you drop 5.2% in the Nasdaq, or over 5%, and in an uptrend and continue on up, or just on a random day like this? It is certainly possible. Again, anything is possible. Is it probable? Absolutely not. It's improbable, and that's what we deal in. So I'm going to show you that right now. So if I drag this to any point, and I just look at any 1 day, I can add to the candles. You want to, red candle, you're going to start at the bottom, and you're going to see that the big drops come during downtrends. Now they said, so we're going to zoom back here. They told us that the journal reported that was the biggest drop since 2020. So what I'm going to do here, I'm going to move this sucker over here. I'm going to zoom in. Let me do one thing here. Okay, I just got rid of the indicators down below. I'll get rid of that trend line that was there. I'm going to zoom. I'm going to walk it back. I'll do it this way so I don't lose that candle. Since I'm using log scaling, we can go back as far as we want, because what log scaling does, if you're not using it, I highly recommend it, especially when you go back longer points in time, because over time the indexes get larger and larger. And what log scaling will do is put all those moves in equal percentage terms. So when you go back, and if you went back 20 years in the Nasdaq, this drop is going to show you the same percentage drop. If you're using linear, in other words, if you use a linear chart, a $10 stock goes up $1, that's a 10% move, right? From 10 to 11. Well, when a $100 stock goes up $1, that's only a 1% move. And on a linear chart, they're going to look the same. That distance will be the same. So what this does, again, it puts in percentage terms and gives you apples to apples comparison. So we need to keep going back a little. Where are we here? Oh, no, there we are. Where 2020 was right here. I went way too far for you. Okay, let me zoom it back in there, and let's just zoom in on this period right there. We can even go leading up to, there's an uptrend before it, right? So what you're looking at here is during an uptrend, there's nothing even close to this as far as a pullback. You don't get 5.2% drops in a healthy uptrend. They don't come out of nowhere. Volatility's low. It just doesn't happen. Those big drops, number one, only come in bear markets or periods of correction. So that's kind of the case I'm making. That's why I think there's more downside. And like I said, once in a while you'll see a drop like that. Here we can play around. You see there's you got to go to the green candle there, and you put it right there, and you can see there's a drop right there comparable to that, the drop that was from that occurred on February 27th when COVID first hit. So there's one period, and yeah, there was one more day of down, then a rally, a counter trend rally, but a lot more downside to come. And I encourage you to do this yourself. Take those days, look there's where we closed. There was the next drop, their next candle. We closed all the way down here, and there was still more downside. But look, each time we had a huge drop like this, of this magnitude or bigger, there was a green day afterwards. So today's green doesn't surprise me. Do we close a day green? Possibly, I don't know. Do we reverse hard, close a day red? I don't know. So it's from a swing trading perspective. I'm willing to ride out a couple days of rallies. If we start taking out overhead resistance levels that really shouldn't be, that's where I just start to scale out, and I can always jump back in. I'm talking about my short positions, but so again, do this yourself. That's where we close. I put it down, and look, boom, another huge down, and there was still more downside to come. Even once we got going, come up here, let's see, I think it was a little bit, yep, there it was. There was a correction right there. So we had, for the first time since that big drop into the March lows and when COVID hit, there was a green candle right there at the top, little hammer too, and boom, you had almost an exact drop right there, because that's where that red candle closed. So this was almost exactly what we dropped yesterday, and you can see it was followed from that point. Even if you shorted that close, there was still another, in the next coming couple weeks, there was another almost 10% downside. And again, I've done this, and I could sit here and show you right now, but you're not going to find any. You will not find drops like this that occurred during an uptrend. Almost in every instance, and you can go back as far as you want, there was more downside to come. The big question is, how much more upside do we bounce today? Do we bounce tomorrow, into tomorrow, or more? And again, at the end of the day, there are no guarantees. Remember, is it possible that yesterday was a one-day wonder and we turn around and rally from here, substantially, 10, 15, 20% upside, and yesterday marks a near-term bottom? Sure, that's possible. Is it probable? No. So that's where we're at. There's the drop right there. And then, and this is where the intraday charts come in. Where should it stop? Well, you've got at the pretty big level now. You come off the highs, the recent highs back from August right there. And you have a early making of a downtrend line, 1, 2, 3 reactions. You've got a gap right here with this is pretty big resistance. You can see on my 60-minute chart, other than we are at resistance now, that was that big level. Remember all these reaction highs, we kept getting rejected, then we broke out of that ascending triangle, we back tested it there. And so with this volatility, we've sliced through it a few times, but it's still resistance. So we're kind of pinched right now with between support, the uptrend line and these horizontal levels right here, the recent lows, and then resistance overhead. So I think at most, if the bearish case is going to stay alive, we might carry up to that trend line. but I don't suspect we'll get that high. You get that high, and what it's going to have done is wiped out most of that candle, and that's somewhat atypical. It's possible, but somewhat atypical to see this candle get completely engulfed now by green candles. But if we do, there's still a massive gap overhead to be backfilled, and traders are going to be looking at that. So if they can enter the gap, they still have to go up and take out the top of the gap and then the top of that candle. So there's plenty of overhead resistance. And so as of now, I'm comfortable being short. And if we're at that point, that where are we on the roadmap where I think we might be, then what's going to happen, and this is a signature move of a bear market, just as this rally starts to look good, feel good, if you're long or convinced you to get out of your shorts, again, if I'm right, just when that happens, that's when, boom, they're going to turn around and start selling it. Institutions will start dumping. Individual investors will start dumping. So we'll see. Work to be done. And again, just if you want to know, okay, well, sounds great, Randy, but what if you're wrong? Well, those are the levels. You have resistance levels overhead that if and as each one is taken out, it's not a line in the sand and all or none, but if and as each one is taken out, especially that 310.90. Remember, that to me was a big level. That was where I was okay with holding on to my shorts and letting this rally carry to and adding to shorts up to that point. That would be a big check mark for the bulls to see 310 get taken out. And to kind of put in perspective, I don't think we're going to get that high. I think they'll turn around and fade this thing today or tomorrow, is my guess. But that's about 4.86, almost 5%. And you got to say, if I'm short now, do I want to give 5% room on my stop? That's completely up to you. It depends where if you're short. And if you're a bull, again, it's easy. You buy support and have a stop on the other side of it. And you can target that bounce. You can target new highs wherever you think the market's going. All right, so those are my thoughts. And then again, if we do break that, yeah, there are some support levels down below, but I suspect we could be at that point where you get the waterfall type selling. And again, that is just look at, go to any long-term chart, and in any bear market, even during corrections, you could get those periods where it's usually towards the end, you get that final kind of big drop. Corrections start out usually slow, like this one has been going. I'm just pointing to that was last bear market. Initial drop, nice rally, and then boom, the big move came down. When the dot-com bubble burst, same thing. You don't just go straight up in a parabolic run and then straight down, at least not in the equity markets. There's too many companies. And the economy turns slow. It's like a super tanker out on the ocean or an aircraft carrier. They don't make tight turns like a speedboat. They make very slow, wide turns, and that's what happens with the economy. But then there's that flash point or point of recognition, usually after that first kickback rally, where the masses kind of realize what's going on, and they finally get the memo, and then everyone starts selling at once. And then selling begets more selling. It's all due to that big margin bubble that we've had. Okay, here, since I haven't covered it in a while, I just Google searched it. You can do the same thing, NYSE or FINRA margin debt. And this is it. There was the dot-com bubble, for those of you old enough to remember that. And if you traded through it or invested through it, you can see the red line is margin debt. And it tends to go parabolic towards the end of a bull market. It starts ramping up, and what happens is people realize, hey, dot-com bubble, the stock market, everything's going up. I'm making 10, 20, 30% a year on my tech stocks or more. Why don't I just go leverage out, and that's what they do towards the end. So you see that surge right there towards the end. Just like in 2007, it was rising, rising, rising. And then the surge, which is a much bigger surge than you see in the stock market. So there was that final surge where it's a collective mentality when everyone, after years of seeing the market going up, that's when the masses, they want to buy at the top, and that's when they also want to leverage up. And by leverage, if you're not familiar, it just means, give your broker $100,000, they'll let you turn around and buy $400,000 of stocks, or they'll let you buy $1 million of stock futures, because those things are leveraged. And you're borrowing, money, and it goes the other way, because when you're chock full of debt, I don't have to tell you. You probably know neighbor, friend, somebody that got over leveraged and got wiped out. And happens to businesses all the time, and it happens to investors all the time. And there's just a signature move there. You get a longer the bull market, the more margin debt goes up, and you can see it flows and gets a little ahead of itself, and there's a correction. And this was that huge surge. So when COVID hit and the Fed went all out nuclear, everybody figured, let's load the boat. Fed had guaranteed us that we have easy money for years to come. That statement, I think, was criminal negligence, in my opinion, for the Fed to say that. Obviously, they completely had to reverse course on that when they pledged to keep rates low for, what was it, through 2024 or 5, some ridiculous number. Or 2023 at least. Anyway, we know what happened there, and you can see the red line, the surge, and so you get these signature tops. That's when bull markets end. And so the question is do you think the bear market is over? It's run its course. If you do, you start buying. There's been a big abatement in margin debt, but if not, look how high the bubble got. And typically, you're going to go quite a bit lower. These bear markets usually last for a couple years. This one was a year and a half. It was quick and over. But anyways, there's probably more unwinding because there's still plenty of margin debt out there, and the bubble has definitely popped. It's just a matter of, is it over or not? All right, I'm going to wrap it up here. I don't want to get into any other charts, or the video will go forever. But we have a kick, like I showed you, natural gas and crude's up today too. And so remember, there's that positive feedback loop right now in the markets with inflation, and all eyes are going to be on it. So the more crude oil and natural gas rally, by far the stronger the more inflationary that is, and the more the Fed's hands are tied. So I had a theory that we're going to see a pullback in natural gas and crude, and they're still off the highs by a good margin. Crude's pushing where I wanted to see it go. I may start scaling out of that one soon if it goes up much higher, but remember, if here I am talking about that potential last final big leg down in the stock market, and I've been struggling with that whole, okay, crude and natural gas are going to go much lower from here. Well, that doesn't mesh well with the narrative. If that does happen, then it allows the Fed to back off. Everyone's going to see that crude and natural gas, the biggest, two of the biggest drivers of inflation, are falling, and that should be net bullish for equities. So it would actually fit better. The narrative would mesh better if we continue to see natural gas and crude go up. Maybe those short trades don't play out right now, or play out any more than they have, and that would be net bearish for equities. So we'll watch that. And then sometimes what will happen too is if equities just crack, if we take out those trend lines and those those next support levels below, here it is, 60-minute chart, and we do start to waterfall down, well, what happens, you can see crude and natural gas fall as well, because at that point you're going to see a couple things happen. Number one, you're going to hear about demand destruction, like I talked about. You see another 20% down in the stock market, which is what I'm thinking. Was that what I'm calling for here? If we hit my next targets on QQQ, I think that's what I said. So roughly from where we're at. Yeah, another 20+% down. That is going to have a huge impact on the wealth effect. People are going to cut back on their travel plans, vacation, business, less business travel, et cetera, et cetera, et cetera. And then you get that demand destruction in crude. So that would, you could see, and probably would see, if this happens, crude coming down along with it. And so we'll see. So right now, that's it. So this video was focused really on the equity markets, and me just kind of reiterating what I think happened yesterday. There's probably more of that to come, and if I'm right, it can be, like I said, just go back in time. Go to 2008, fourth quarter of 2018, I mean. Go to the March lows when COVID hit. Go back to the 2007, 2009 bear market. And so if you think that we were oversold yesterday, we're oversold on the very short-term charts. That's why we're bouncing today, 5-minute, 10-minute. But if you think that the market can't follow up with another 5% or another 6 or even 9% drop, then you just have to go back and look and see what happened at those points in history. And that's just the nature of a bear market. It's selling begets more selling. All right. I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.